Have you ever wondered what an ETF is and how to invest in one? Well, let's break it down. ETF is an acronym that stands for Exchange Traded Fund. Imagine it as a basket of different investments, all bundled together. It's a type of investment fund, yes, but also an exchange-traded product. Now you're probably wondering, what does that mean? Simply put, ETFs are traded on stock exchanges, just like individual stocks. But unlike stocks that represent a stake in a single company, an ETF represents a stake in a diverse range of assets. Here's an interesting fact. ETFs share similarities with mutual funds. However, there's a twist. Unlike mutual funds that have their net asset value calculated at the end of the trading day, ETFs have their prices updated throughout the day, just like stocks. Now that we've covered the basics, let's delve deeper into how ETFs work. So how do ETFs operate in the financial market? Well, in essence, exchange-traded funds, or ETFs, provide public investors with an opportunity to have an undivided interest in a pool of securities and other assets. This might sound like a mouthful, but it's actually quite straightforward. Imagine you're at a buffet, but instead of food, the buffet is filled with different types of assets: stocks, bonds, commodities, and so on. Now, instead of having to choose and buy these assets individually, an ETF allows you to buy a plateful of these assets all at once. This plate represents your undivided interest in that pool of assets. The design of ETFs is such that they aim to track the performance of specific indexes, sectors, commodities, or even broad asset classes. For instance, an ETF might track the performance of the S&P 500 index or the technology sector. This means if the index or sector that the ETF is tracking goes up, the value of the ETF goes up, and vice versa. It's like having a mirror that reflects the performance of a particular market segment. One of the standout features of ETFs is their flexibility. ETFs trade on stock exchanges just like individual stocks and can be bought and sold at current market prices at any time during the trading day. This is a significant difference compared to mutual funds, which only transact at the end of the trading day at a price equal to the net asset value of the fund's holdings. With ETFs, you can act on your investment decisions in real time, offering a level of control that mutual funds simply can't match. So there you have it. ETFs offer a way for investors to gain broad exposure to a variety of markets, with the added benefit of flexibility and real-time trading. They're like a buffet of assets that you can buy into, reflecting the performance of the market segments they track. With a clear understanding of how ETFs work, the next question is, how can you invest in them? Investing in ETFs can be a smart way to diversify your portfolio, but how do you go about it? Well, the journey to investing in exchange-traded funds, or ETFs, begins with setting up a brokerage account or getting in touch with an investment advisor. This is because ETFs trade on the stock exchange, much like individual stocks, and therefore, you can't simply buy them directly. Instead, you need a platform such as a brokerage account that allows you to participate in the stock exchange. Now, before you jump into the ETF pool, it's crucial to do your homework. Consider it as a due diligence process, where you research and understand the ETFs in which you are interested. And there's a lot to learn. You need to understand the ETF's objective. Is it designed to track a broad market index, a specific sector, or a certain commodity? Knowing this will help align your investment with your financial goals. Next, look at the ETF's holdings. What assets does it hold? Stocks, bonds, commodities, or a mix? The holdings can give you a good sense of the ETF's potential risk and return. Then consider the ETF's performance history. While past performance isn't a guarantee of future results, it can give you an idea of how the ETF might perform in different market conditions. And don't forget about costs. ETFs come with expense ratios, which are the fees you pay to the fund manager. A lower expense ratio can save you money in the long run. Lastly, remember that investing is not just about picking one winner. It's about building a diversified portfolio. That's where ETFs shine, as they allow you to invest in a broad range of assets with a single purchase. ETFs can be a valuable addition to your investment portfolio, offering diversification and flexibility. Remember, the key to successful investing lies in understanding your investment choices and making informed decisions. So take the time to learn, plan, and invest wisely.